Stocks slide as India-Pakistan tensions rise following the terrorist attack in Pahalgam. Utilities, industrials and healthcare are the big losers, with mid-caps bearing the brunt.
Axis Bank slips on weak loan growth and Tech Mahindra recovers from its morning lows, reacting to a mixed set of results, while SBI Life has climbed on a strong margin print.
Apple is likely to consider making India a hub to manufacture all Apple phones for the US market by next year, say sources tell CNBC-TV18. The decision to shift production will depend on adequate capacity ramp-up in India and the trajectory of US-China trade talks.
China's restriction on export of rare earth magnets is starting to hurt Indian electric vehicle makers, from whom this is a critical component. China is calling for end-user certificates from India's foreign ministry and the Chinese embassy for further supplies.
Investors look forward to Reliance Industries' fourth quarter earnings today, more so for the management's commentary on strategic issues than earnings. Analysts expect a steady quarter, with Jio's good show likely to be offset by softness in retail and a mixed show in oil to chemicals.
Good afternoon. You're with us here on Halftime Report, live from the CNBC-TV18 Motilal Oswal studios. I am Hormas Fatakia. With me, as always, is Mangalam Malu. Well, not a very good-looking screen, Mangalam, at the final trading day of the week. Of course, there are some tensions, so traders looking to keep their positions light as we head into the weekend.
Absolutely, and it's also the start of a new series, right? The market actually, after a near 2,500-point recovery from lows in April series, needed a reason for profit booking, and that exactly has come by. Nothing really to worry about as of now, but like Hormas pointed out, there is a reason for traders to perhaps look at lightening some of their positions. The reason I say there's nothing to worry about is because at lower levels, there is some recovery. Not particularly on the index, as you can see, as at the low point of trade, the Nifty banked down 1,000 points as well. But look at the recovery of the day. Tech Mahindra, that is one of the biggest stories, right? Up nearly 6.5% from lows. Rima this morning had told us that these numbers aren't particularly bad. In fact, it's a decent show that has come in. And that's something that we've seen in IT stocks all through this week. The Nifty IT index comes up for you. For the last 3 trading sessions, Wall Street has been doing well. And IT index, after being battered out of shape, has continued to be fairly resilient, above important moving averages as well from a technical standpoint, and now holding on to gains. So supporting the index on the downside, and that's something we'll most definitely keep an eye out on. That's the IT index today. But if you look at the entire week, the Nifty IT index is actually among the top performing indices this entire week, with a gain of anywhere between 7 to 8%. So that's about the IT index, about 7% in the last 7 trading sessions. But the big development that we're tracking is coming in from Apple, and that's amidst the tariff wars right now. Apple aims to source all their iPhones, the US iPhones, from India in a pivot away from China, something that they've been trying to do for the last few years, but now maybe accelerating because of what's taking place between US and China in terms of trade wars. Parikshit joins in with the details. Parikshit.
Well, yes, Apple is considering manufacturing all phones for the US market in India, and India could possibly become a hub for Apple phones by next year. But this is the intent. It is a plan on the table right now, considering where the geopolitical situation is and the trade war with China is. The Chinese tariffs on certain products are as high as 245%, and the average reciprocal rate is almost 145 to 150%. Currently, in this environment, the US believes the right place to manufacture phones and export them to the US market is India. But a lot could change in case there is a US-China truce. Having said that, the company is considering increasing production to 40 million phones in 2025 itself. Now, if you look at the production last year, it was around 25 million to 26 million phones, and this year it could be as high as 40 million phones. Apple contract manufacturers in India are ramping up capacity. The Chennai plant has a capacity of around 20 million phones per annum, and that capacity is being maximized as much as possible. Foxconn's Bengaluru plant, which is a contract manufacturer for Apple, that will be operational within this month, and it will have a capacity of 20 million phones per annum at peak capacity. It will take some time to reach there. So yes, India in a geopolitically advantageous position right now, but a lot could change if US and China were to have a truce tomorrow. Apple did not respond to CNBC-TV18's queries.
Parikshit, hold on, because you're tracking another story, right? There's industry sources are also telling CNBC TV18 that Indian electric vehicle makers are facing challenges because China has stopped the supply of rare earth magnets to India. What are you picking up here?
Well, rare earth magnets are extremely important for electric vehicle manufacturing. They're used in EV motors, in traction motors, and this could possibly challenge EV makers and component manufacturers in the country. Currently, there is inventory in the system. So next few months, there might not be a problem. But within a few months, if things don't change, the production could slow down and Indian EV makers could get impacted. So what's China doing? From the 4th of April onwards, they've put a condition that an end user certificate must be applied for and must be submitted by every company which is looking to buy and import rare earth magnets from China. Now, this means you have to get a notarized document saying that this is only for manufacturing vehicles and this is not going to be used for either weapon making or it could be given to third parties. So you'll have to give that declaration. Secondly, this end user certificate will not just have to be signed by the Ministry of External Affairs or the Indian Foreign Ministry, but also the Chinese embassy here in New Delhi. So this makes it complicated to get this dual authorization. The auto industry bodies and also the auto component makers have reached out to the Ministry of External Affairs for help. We believe that they will also be approaching the Ministry of Heavy Industries, the Ministry of Commerce for help as soon as possible. Let's see what happens. But yes, clearly there is some amount of alarm and panic in the auto industry as to what this restriction, this non-tariff barrier, so to say, could impact and the manner in which it could impact the auto industry.
Take that point entirely, Pariksha. Thanks so much for that. Those are some industry-related updates coming in. Meanwhile, before we slip into a short break, just keep an eye out on a couple of these mid-cap names which are seeing a fair amount of sell-off. Cyient continues to do weekly in today's trading session. L&T Tech Services as well. SBI Card, Z Entertainment, that's the one that should come up for you. Currently at the low point of trade, and we are seeing some sell-off in names like ACC, Berger, and Nippon Life as well. Take a short break, and as we do that, we also get you a programming note. CNBC TV18 and HSBC India are back with Season 2 of SME Champion Awards. This prestigious platform celebrates SMEs that are pushing boundaries, making an impact, and shaping the future. Nominations are now open. You can scan the QR code which is there on your screen and submit your entry for the SME Champion Awards Season 2. But even as the markets are lower in today's trading session, they've actually taken a bit of a sigh of relief after Donald Trump hit a pause in tariffs, and markets globally around the world are starting to come to terms with the reciprocal tariffs itself. This is about today, but if you look at the Nifty over the longer period of time, you've seen a bit of an up move that has come by. The world is, now coming to terms with the uncertainty that was earlier there. They're mapping it all out as well. So what's the roadmap for investment ahead? Our colleague Prashant Nair caught up with experts from Nomura to discuss what's next. He began by asking Rob Subaraman, who's the head of global macro research, when can we see finalizing of trade deals and what one should do in the stock markets itself. Listen in.
I don't think they'll be done quickly. I think trade deals take a very long time to do. Okay. I think the Trump administration will try to dress up some quick wins with some close allies and hopefully try to get some tariffs down. But, our view is that once tariffs go up a lot, and they have gone up a lot, we think the effective rate's 21%, they don't tend to come down that quickly. And so our baseline is tariffs are going to stay up pretty high. I think China has quite a bit of leverage over the US, and that trade tension will continue. And ultimately, Trump wants tariffs for revenue as well. So, tariffs are going to have a big macro effect on the US economy and economies everywhere this year is our bottom line.
So with China, what we've been hearing over the last 48 hours, should we read this as a bit sort of conciliatory, tempering things down a little bit, or is that reading into too much? I mean, things could change. We could hear something different over the coming days. What's your sense?
Well, look, right now, US tariff on China of 145%. I mean, essentially for a lot of trade between US and China, it's essentially stopped.
Correct.
So there will probably be some coming down. But the point I'd make is...
So between 10 and 145, there's
there's a big range, right? So
and Trump was, before election, said 60%. So will we get down to 60? What, I mean,
we could get down to 60. And that has been our kind of a longer-term baseline around 60. But the point we'd make is that's still extremely high. And that is going to lead to a lot of, I think particularly for the US, a lot of inflationary effects. And it's going to hurt growth. Rest of the world, it's a different impact. It's more of a demand shock for the rest of the world, lower growth and less inflation. So there's going to be also a disconnect between central bank responses. We think the Fed is not going to be cutting rates quickly because of the inflation. We have the first cut in December. But for other central banks around the world, there's a lot of room for cutting rates.
you're saying that foreigners, and especially central banks, are selling US bonds. I mean, that has been happening, Japanese especially.
So we haven't seen it in terms of central banks.
Okay.
The data is actually
So maybe investors,
mixed.
etc.
It's actually quite mixed. But you know, you have on one hand the Treasury data, which shows you there's some direct selling from Europe. There's some direct selling that's coming from, let's say, China, Asia, ex-Japan as well. But then you have the safe haven, or the tax haven, should I say, places where you have seen actually buying. So it's a bit of offset. There's no consistency really about it on the central bank space. But certainly on the private side, it looks like something is happening there on the actual asset unwind.
I think that's the interesting thing. I think the central banks around the world have been diversifying away from US dollars, their reserves, for a long time. The new interesting thing is the private sector. Private institutional investors, big lifers, pension funds around the world, are they starting to diversify away from the US?
And the reaction, what we saw was interesting, right? Usually when stocks go down, I mean, bonds go up. But here you had a situation recently when everything was getting sold.
Yeah, long end US Treasuries, equities are being. It was basically almost get out of the US. That's
So that
was the
phrase
direction.
US exceptionalism, are we at the end of it? What's your sense?
I mean, I wouldn't push it that far away at the end. I would certainly be saying that it's fading, right? That the evidence we're seeing is that it's fading, but at the end is still quite, you know, I think of a push. It's a push to say that.
Sonal, let's come to India. It seems like we're first in line to get a deal. Would you agree?
Hopefully. I think we definitely have a head start. We started the negotiations ahead. The terms of reference have been finalized. India is a strategic ally. Now, you know, deals take time. Agriculture is a politically sensitive subject for us, but there are other aspects of the agreement on the industrial tariff, parts of the non-tariff barrier, you know, buying more of US products, which can easily be done. So I think if we can get the 26% reciprocal tariff down before the deadline, and our tariffs are lower than our competitors, then really in this world, what you're looking for is a relative advantage. And I
But
think
will we have that relative advantage, Sonal? Because others also will negotiate, right? Others will also, I mean, for example, competitors in various industries like Vietnam, Cambodia, I mean, they'll also want to sort of lower tariffs, their respective tariffs, right? So it's all relative, as you said.
So I think most Asian countries are trying to negotiate with the US. The question is whether what they are offering will be acceptable to the US. One part of the deal is buying more of US products, but for countries like Vietnam, Cambodia, transshipment of China products has been an important reason for the reciprocal tariffs. Also, these other aspects of, you know, non-tariff barriers or whatever we want to call them. So, you know, and right now we are seeing China trying to, you know, also talk to Southeast Asian countries. It's putting Southeast Asia in a more difficult position in terms of choosing between US and China. I think for India, it's a lot more clear-cut. We don't have that transshipment problem. And therefore, I do think, like, relative to a number of our competitors, we do have an upper hand.
How long before we see a deal? I mean, do you have a number in mind? How many days? How many months? With India, US?
No, I think the definition of deal is important. The trade negotiations run into years.
Yeah.
It's a deal on goods. It's a deal on services. This is going to take time.
But this is like the COVID emergency. We got the vaccine. I mean, COVID hit in Feb. We got the vaccine in November.
The early tranche on some bits you could probably agree on by the 90-day, but the first tranche, of course, we are planning by September or October. The big deal, the real deal, is going to run into years.
Sign for equities. We're again back to, equities are snap back, right?
Yes.
And FIs are coming back, about a fraction of what they've sold over the last 8 months or so.
Right.
But they're coming back.
Absolutely.
But, very quickly here we tend to go back to high valuations and you're suddenly scratching your heads, now what, right? And you're waiting for earnings. I think your expectations in terms of earnings is lower than the street.
That
right. Comes off the 5.8% number from Sonar.
Yes. So, yeah, Prashant, so basically, when we look at, through the pandemic, from fiscal 19 to 24, we had an, very strong earnings growth, north of 20%. Last year was a slowdown, fiscal 25. Now, fiscal 26 and 27, again, the expectations are around, mid-teens earnings growth. So if you look at, there's a lot of catch-up in earnings which has happened over the last 4-5 years. And if you remember the entire decade from 2010 to 20, we were struggling with corporate earnings, right? Consistent earnings cut. It was bound to happen, natural, sort of going back to a natural level of earnings and ROEs was bound to happen, and it happened over the last few years. So earnings to GDP ratio has bounced back. In fact, it's now very close to 2008, which is, just before the global financial crisis.
Sure.
With the kind of uncertainties, that we are currently dealing with, and if you look sector by sector, right, the profit margins are, on the higher side. And we are seeing downgrades there. So therefore, I think that, earnings to grow substantially above, let's say, a nominal GDP growth of around 10%, looks challenging, at least in the near term. And that's why we think that we will continue to see earnings downgrade. And on your question on valuations, right, I guess, currently we are just shade below 20 times 1 year forward earnings. We have breached 20 times in the past, especially in the last few years. But I think, it's very difficult at this point to, foresee that level of valuation. So far, if you look at, there are, certain things which are in favor, like for bond yields are falling, which is positive for valuations. And the risk premium actually hasn't really flared up. It's still behaving.
But that's a risk. That's a risk.
That's a risk.
There's some recovery from the lows of the day for the Nifty now, almost 110 points higher from the lows of 23,847 that we have made. We are now above the 23,950 mark as we speak, but still 300 points down on the index. The broader markets too, at one point, the mid-cap index was down almost 1,600 points or almost 1,700 points. That too has seen some bit of recovery, almost 400 points now off the lows of the day. We take a short break. Ajit Mishra of Religare Broking joins in on the other side with a chart check and some trading ideas as well. Stay tuned.
Welcome back. You're watching us here on Halftime Report, and perfect time to get you the F&O update at midday, day one of the May series. And it has actually started on the back foot if you are a bull. So Nifty down 300 points, the Nifty Bank down almost 800 points. So from record highs, we are seeing some profit booking on that index. The Nifty as well had seen a rally of almost 2,500 points from the lows. And we have the mid-cap index, which is doing a lot worse as well. The India VIX has spiked as we've seen some profit booking in the market and from lower levels itself. And the market bread tells you a story of the day where we are in the mood for profit booking, where we started with more stocks advancing. Thereafter, there was this intersection. And now as we speak, these lines have been parallel, but not before widening as far as 10 stocks in the red to 1 stock in the green itself. But there has been remarkable recovery in a couple of names as well. Even though the Nifty is broken below the 200-day moving average, closing above that would be something which everyone will be looking at as a next level on the way up whenever that happens over the next, couple of days or couple of weeks, etc. But Tech Mahindra, look at the intraday chart, nearly 6.5% recovery. So were the Nifty to go ahead and reconquer the 200-day moving average, IT will have to play a strong part, which has been a strong index this week. And alongside that, some recovery from the lows on Nifty Bank as well. But as far as the options that expire next week are concerned, the option writers have made their call. On the way up, 24,000 call has seen a fair amount of writing for 222 rupees, telling you levels upwards of 24,200 might face some supply. In fact, we've also seen writing at the 24,200 call itself, 24,300 call. So 24,250 to 24,350 is the supply zone for the market. But at the lower level, we are at around 23,900, and that is where a lot of the put writers are fairly active as well. So 23,900 put, telling you that close to around 23,750 to 23,800 is where the support is likely to be seen for the frontline index. Looking at a couple of stocks now, we do have a bunch of them which are in focus. A lot of long positions added on SBI Life. We'll shortly be speaking to the management post their results as well. And then a lot of short positions added on names like Cyient and Inox Wind in particular. So we'll most definitely watch out for that.
We'll watch out for that indeed. Some important triggers to watch out for the May series, but there is indeed some recovery from the lows of the day. Ajit Mishra of Religare Broking joins in on the show now. Ajit, good afternoon. Thank you for joining in. Is this much needed dip that the bulls were hoping for to re-enter into the market after that 7-day rally? Would you use this to re-enter and initiate longs, or would you wait on the sidelines for more clarity to emerge?
Yeah, good afternoon, Homer. So yes, I would have said yes to entering fresh, considering that if we have more days to the trading days to the week, because now we are seeing this unfolding new event unfolding related to India and Pakistan. So this thing has definitely dented the sentiment. That kind of rebound that we've already experienced from the recent lows. Market was anyways trying to find some reasons to correct after 2-3 days of consolidation. I would rather prefer to sit on the sidelines and see whether we manage to hold this area or not. Means 23,800, which was previously acting as a resistance, should act as a support now. The major support exists around 23,400 mark, where we have all the major averages are aligned. So maybe next week, at the beginning of the next week, we can consider going long if Nifty manages to hold this 23,800 mark.
What about specific stocks, Ajit?
So in a market like this, almost it's prudent that one should maintain position on both sides. So one stock which has been holding well amid all this choppiness is Marico. The stock is trading to its record highs, closer to this record highs, and we are seeing the consistent outperformance within the FMCG space. So 740 is what we are eyeing in Marico in the near future. So with stop at 695, one can go long. At the same time, IGL is offering a fresh shorting opportunity after this recent attempt of failure to reclaim its short-term averages. It has formed a fresh shorting pivot. So 172 is what we are eyeing in IGL on the lower side. So with stop at 184, one can go short in IGL at current levels.
All right, Ajit, thank you so much for sparing time and joining us today with your views on the index and on specific stocks as well. Take a short break. On the other side, the management of SBI Life joins in to talk about their fourth quarter numbers. Stay tuned. Welcome back. Still 100 points off the lows of the day now for the index. So there is some recovery that we are seeing from the lows, some buying interest emerging. Now it'll be interesting to see as we go into the second half of the trading session whether this bounce is being used to sell into, or this actually sustains and we cross that 20-day moving average as Manglam was speaking about just a few minutes earlier. By the way, SBI Life is continuing to trade around 4.5% higher, is the top gainer on the Nifty 500. Of course, at one point was up almost 9%. Brokerages are expecting targets of in excess of 2,000 rupees on the stock. So we'll keep an eye out on that. But of course, the story of today has been mid-cap IT, be it Emphasis, be it Persistent Systems, be it Coforge, and of course the recovery in Tech Mahindra, but that's of course a large cap IT name. But it is the mid cap IT that has dominated proceedings today. Emphasis is now up 4%, and Persistent Systems also is up 2.5%. Coforge is up 1.5% as well. But of course on the other side, the other mid cap IT name that has not done very well is Cyient. That's down around 5.5% in today's session. Among the top losers in the broader markets though is Motilal Oswal. Numbers should be out anytime now in a few minutes. That stock is also down 7% as we speak, as the top loser on the Nifty 500 ahead of its results. And Garden Reed Shipbuilders too seeing some bit of selling pressure in today's session. That too is down 6.5% in today's trade. But we were talking about SBI Life, and the numbers were higher than expectations, with VNB margins rising over 220 bips on a year-on-year basis. My colleague Yash Jain spoke to Amit Jhingran, the MD and CEO of the company, and began by asking about their anticipated growth outlook for the new financial year. Listen in.
These numbers have been a result of the continuous implementation of a strategy that the company had for the entire financial year, and particularly the Q4, we have been able to reap the results of whatever we did in the first 9 months. That resulted in growth on a very strong pace. You will notice that this 9% growth on individual APE basis, it is around 13%. So we are satisfied with the kind of growth that we have got. And going forward in the next financial year also, we are looking at a growth of around 14% on individual APE basis.
Okay, a 14% growth on the individual APE basis, and considering the share which individual APE has out of total APE, what is the kind of growth that you anticipate on the total APE basis? Because that will also help us to understand, the things on VNB as well as the margin side.
Company is very mindful of having a growth which is optimal for all the stakeholders. So you would have noticed that during the last financial year, our group mobilization was somewhat muted, and that was because of the market conditions. We didn't find it worthwhile to go very aggressive, because that would have been margin negative. For the coming year, we will see how the interest rate scenario in the market works out, and depending on that, we will have appropriate strategy in the place.
Okay.
We will be continuing to be mindful of the optimum benefit for all the stakeholders.
Okay. But the number on the total APE basis, do you have a number in mind, just like you're targeting?
It should be somewhere around 12%, I believe.
Okay. One question that I want to understand before I speak to you about the margins is on the ULIP portfolio. Of course, for the industry, less for you, but still a higher ULIP portfolio, higher traction there does impact margins negatively. Now, in the Q4, because of the market volatility, the ULIP interest did come down for players across the industry. For you, I want to understand Q4 FY25 on a year-on-year basis, how did the ULIP share change out of your total product mix? And now Q1, is the demand for ULIP starting to come back again, or do you think it's more or less stable at the same level?
The contribution of ULIPs in the Q4 for the company was also muted, but it was on account of two factors. There was one, volatility in the market, which might have affected. But secondly, also company's conscious strategy to have a healthy product mix. We launched 4 new products in traditional segment, in participating, non-participating segment, in the children segment and all. And during the quarter, we got some good traction. We also focused on making our agents and distributors active on these products. So that resulted in a healthier mix, lower ULIP portfolio in the Q4.
If I have to now speak to you about the margins came in much ahead of estimates, about 30%. Now, I just want to understand from you, in the Q4, what helped the margins going forward? As I said, your AP is expected to grow at about 12%. That will align in your favor. You'll have a better product mix, a more stable product mix, and favorable base effect also. For FY26, where do you see the margins to come in?
So during Q4, our VONB margin was at 30.5%, which showed a healthier growth on account of the change in product mix, which the company has been planning for last 3-4 quarters, and it started yielding results.
Okay.
Going forward, we provide a guidance of around 28% at the existing level for the next financial year also.
Okay. You said you are providing a range. Now, when you say 28%, would the range be 26 to 28% or would the range be 28 to 30%?
I will say it will be around 27 to 28%.
27 to 28%.
Maybe some positive bias.
Okay. So as you said, a total APE growth of around 12%, retail APE growth of about 14% is what you expect, and margins of about 28%.
Yeah.
Right? Accordingly, would the VNB be about 13 to 14%? Is that understanding
Yeah, that
correct?
is what I am looking for, around 14% of VONB growth also.
VNB growth. One other thing that I want to understand, and this is on the distribution mix. You've been focusing very strongly on the agency network also. The agency is growing much faster than bancassurance. What is the growth that you expect in both agency network for FY26, bancassurance for FY26? And as far as the distribution mix itself is concerned, now if I look at the numbers, your distribution mix from bancassurance did come down in the financial year as compared to agency. Where do you see more changes coming in that distribution mix between agency and bancassurance in FY26?
Company has identified a lot of opportunities in the agency channel also. And that is why in last financial year, from the month of April itself, we launched an initiative called Agency 2.0. We have been opening more number of branches, employing more agents, and also trying to improve the agent productivity. All this has resulted in a good growth of 23% in the agency channel in last financial year. So this higher growth in agency channel has provided us in mitigating some of the concentration risk in the distribution channel, also improving the agency channel contribution by around 2%. Going forward also, we will continue to tap opportunities by creating more infrastructure in agency channel, opening more number of branches, and improving agent productivity. So we are looking for around 25% growth in agency channel in the current financial year also.
In the current financial year, the share right now of total APE between bancassurance and agency is 61% to 28%. How do these two numbers change with the growth that you're anticipating?
So we are looking for a 25% growth in agency channel, which may give a agency channel contribution of 30% plus in the coming
30% plus. And bancassurance will come down in a similar proportion then in that case?
Obviously, but not because of any reduction in bancassurance channel, but because of the higher agency contribution.
Okay. Just a little word on the higher surrender value. It kicked in from October, the regulations. Has there been any impact on the margins? Though the margins have been strong, but still, could the margins would have been a little stronger if, not for higher surrender value? Do you think there was some impact in the second half of FY25? And in FY26, do you stick to what you had said, that the impact on the margins won't be more than 50 basis points because of higher surrender value?
What was in favor of the company that our surrender values prior to the regulation were also higher. So with the introduction of new product range in line with the changed regulation, our pricing didn't get affected much. So the actual experience of surrenders will start coming after 1 year of the product introduction only. So we are very sanguine that our assumptions, whatever we have made for the new product range, will stand out, and we will see how the actual experience vis-a-vis our assumptions come out, and will decide accordingly.
Right, that was the management of SBI Life. The stock doing extremely well. The management sounding reasonably optimistic as well. With that, we'll take a short break, and as we do that, even as the market has shown some signs of recovery, and we started the show, it was closer to 23,900. Now it's closer to 23,975. So there has been a recovery from the lows. We'll get you some good news. That is India's business news leader, which is CNBC-TV18, is now just a click away, which is the CNBC-TV18 all-new app, which gives you instant access to breaking news, in-depth articles, financial world updates, all of them at your fingertips. What you got to do is download the app, and you can either get it from the Apple Store or the Google Play Store, or just scan the code, which is there for you on the screen. Welcome back. Sources say, tell to CNBC-TV18 that the spectrum dues to telcos' equity conversion is not automatic. Telecom department is open to considering applications for telcos for equity conversion. What this means and what are the stocks on our radar? My sense is it will be Vodafone Idea that will be impacted by this. We'll get Ashmit for bringing more details. Ashmit.
Well, important clarification coming in. We spoke to various government officials. What they're telling us in very clear terms is that as far as the application process is concerned for this equity conversion, this conversion will not happen under an automatic route. So just because a company has made an application does not mean that automatically that spectrum due or that AGR dues gets converted to government equity. What the government officials are telling us is that there is a process, that there is a certain amount of discretion that the government will exercise in terms of converting these spectrum dues to equity. In fact, there will be application of mine and a decision will be made on a case-to-case basis is what various government officials are telling us. So essentially clarifying, it's not an automatic transition that takes place. What government officials also tell us is that companies, of course, are free to apply under this scheme, under the 2021 cabinet scheme, and that the government will take, the government is not bound to make that transition, but that the government will take an informed decision and will exercise discretion on this conversion. Another key clarification that has come in from government officials is that both AGR dues as well as spectrum dues will be eligible for conversion under this equity conversion scheme. And that, of course, is where we need to bring in the context. So far, the only equity conversion that we've seen so far is in the case of Vodafone Idea. What government officials have previously told us is that now the fresh applicant is Bharti Airtel. Bharti Airtel is also seeking parity with Vodafone Idea, is seeking similar treatment with Vodafone Idea, and therefore is seeking this conversion. And just to set the context, in 2021 is when this cabinet relief had been allowed, had been granted the nod. And under this 2021 scheme, at least as per the language that was used back in 2021, it was eligible. Only spectrum dues that were for spectrum that was bought before 2021 is something that was eligible for this equity conversion. So clarifications coming in from highly placed officials within the DOT. Back to you.
All right, Ashmit, thank you so much for that important update there. Meanwhile, IEX is the other one that's doing well for itself today after a mixed fourth quarter. Revenues were below analyst expectations while profits were in line with what the street was anticipating. Vinny is joining in with more on the numbers and what the management had to tell us earlier in the day. Vinny.
Hi, afternoon. So in terms of IEX numbers, it is a mixed number like you mentioned as well. Revenue was below what the street was expecting. Motilal Oswal even highlighted that this could be mainly due to the reason of low per unit transaction fee that is there, and that could have been something that impacted the earnings of IEX, especially in terms of revenue. Profits in line with estimates. Profits saw a growth of around 21% on a year-on-year basis, but EBITDA margins, that's seen a contraction of 93 basis points YOY. Now, what the management actually spoke to us about, because volumes is the key for IEX, right? So they said that they've seen electricity volumes that grew by around 19% for FY25, as well as the certificate volumes growing by around 100% in FY25. They expect this 18 to 19% growth in FY26 to continue as well. They saw a jump of 100% in IGX volumes in Q4, and they see a good growth potential going forward from here on as well. So we could see this building on in terms of momentum from here on. Other than that, there is a lot of inventory is what the company highlighted, and they expect prices to remain stable. And now given the stabilization in prices, they are saying that there is some bit of a room in terms of growth that they could have here on. So IEX, that's why it's in focus. We're seeing a gain of almost more than 1% in today's trading session as of now.
All right, Vinny, thanks a lot for that. It's the mid-cap IT stocks which are on our radar as well. In focus was their fourth quarter earnings. Companies like Persistent Systems and Mphasis beat street estimates. Mphasis actually is currently at the high point of trade. We have L&T Tech and Cyient, which were a miss as well. So which is why we have, L&T Mindtree, which is L&T Tech Services and Cyient, which are lower in today's trading session by about 5 to 6%. Rima joins in to tell us more about the report card of the mid-cap IT numbers that have come by so far. Rima.
Yeah, there's been a flurry of, mid-cap IT earnings. But if you had to summarize, you could say that the strong are getting stronger and the weak are disappointing. So when you mean by strong, we're talking about companies like Persistent, Mphasis, and Coforge is still awaited. But these are the companies which have positively surprised the street despite the tough macro, while companies like Cyient, LTTS, which have had a few rough quarters and the stocks have underperformed, have disappointed the street. Now, onto the numbers. This time, Persistent, Coforge and LTTS reported a positive revenue growth. But the beat came in from Persistent, 4.5% versus estimates of 3.8%, and Emphasis was also slightly ahead of street expectation. LTIM, LTTS, Cyient missed the mark on the top line. For LTTS, the numbers look good, like you see a 10.5% revenue growth, but that includes the IntelliSwift acquisition. The estimates were actually for a 13% growth, which is why L&T Technology Services, despite the double-digit top-line growth, is actually a miss. Now let's quickly get to the guidance. Now Persistent maintains its FY27 annual guidance of $2 billion, $5 billion by FY31. They're also on track to improve margins by 200 basis points, and they're also hopeful of outperformance. Emphasis is guiding for above industry growth rate. LTTS is saying that FY26 should be better than FY25. They're looking at a double-digit growth rate, but some people on the street were hoping for a stronger guidance. So, their own internal estimates were that LTTS would do a high double-digit kind of a growth given the acquisition. So, in that context, just a double-digit has disappointed the street. And Cyient is the one, where the guidance is actually the most dismal. Firstly, there is no revenue guidance. They expect the uncertainties to last for the first half of the year, and even the margin aspiration has been lowered and pushed further down. Now they're looking at a 15% margin over the next 2 years.
Mid-cap IT indeed stronger, getting stronger, the weaker not doing very well for itself. But from IT we move to auto as the sector begins its results today with the onset of Maruti, and with our offering quarter se quarter tak, Sudarshan is here to highlight what the street is expecting from the auto sector this time around. Sudarshan.
So the Indian auto sector has faced a turbulent FY25 with overall sentiment subdued, particularly during the second half of the year. Macroeconomic headwinds, uneven rural recovery, regulatory changes and shifting consumer preferences have all contributed to the sector's volatile performance. For the last quarter of FY25, the divergence in growth projections is becoming increasingly evident, with estimates ranging widely from a modest 2% to a robust 23%. Reflecting varied expectations, let's begin with the reported volume numbers across key categories. On a year-on-year basis, tractor sales have emerged as the biggest outperformers, aided by relatively stronger rural demand earlier in the year. However, on a sequential basis, the same tractor segment has witnessed the sharpest decline, indicating weakening momentum and seasonal moderation. Excluding tractor segment, most other segments have posted modest year-on-year growth. Two-wheelers and three-wheelers have seen low to mid-single-digit growth year-on-year, with sequential declines driven by soft rural demand, higher base effect and limited festive tailwinds. Passenger vehicles and commercial vehicles, in contrast, have reported sequential growth, with PVs benefiting from stronger demand and SUVs and new model launches, and CVs gaining from infra and construction-related activity. On the revenue front, the overall sector is expected to post around 10% year-on-year growth. In Q4, however, as with volumes, the revenue performance will be far from uniform. The two-wheeler segment is expected to show the widest range in performance, with estimates varying from 2% at the lower end to 23% at the upper end, depending on product mix and pricing power. Four-wheelers are projected to deliver double-digit growth, supported by a strong mix of premium and mid-segment offerings. Notably, tractor segment is expected to outperform on a revenue basis, with an estimated 20% growth on year-on-year. And that would be largely driven by pricing actions and earlier demand strength. Amid this uneven landscape, certain players are expected to emerge as outliers in terms of performance. In the two-wheeler space, TVS Motor and Eicher Motors are likely to surprise positively. TVS is benefiting from urban recovery and premiumization trends, while Eicher continues to gain traction through Royal Enfield's steady domestic and export performance. Among four-wheelers, Mahindra & Mahindra stands out with a strong SUV portfolio, robust order book and agricultural equipment division contributing positively. Within auto ancillaries, Samvardhana Motherson is positioned to be sectoral outperformer, aided by global diversification and increased content per vehicle. From a valuation standpoint of view, the sector appears relatively attractive. With a few exceptions, most auto companies are currently trading at or below their 5-year average price to earnings multiples. And as far as stock performance is concerned, except TVS, Eicher, Maruti and Ashok Leyland, all the companies that you can see on your screen here have given negative returns in 2025 so far, with biggest declines seen in auto ancillary names on the back of global uncertainty. Let's wrap with the outlook. In the near term, outlook for the sector looks optimistic. The anticipated implementation of the 8th Pay Commission and income tax reliefs are likely to aid the growth for two-wheelers and lower-end car segment. And for tractor segment, Met Department has predicted above normal monsoon for current year, and that is likely to boost rural income, leading to an increased demand.
Right, Sudarshan, thanks a lot for that comprehensive outlook into what one can expect from the auto sector in the fourth quarter. We're awaiting numbers from Maruti, but seems like from everything that has been expected so far, tractors would be the clear winners in the fourth quarter. Take a short break, come back, get you more on the markets and a lot of stock-specific action.
Welcome back. The bulls fighting tooth and nail to get the Nifty back to that 24,000 mark. Is still at 23,970 as we speak. And of course, all eyes are on the big boy Reliance Industries. They'll be reporting results after market hours later this evening. And Rima is here to tell us what to expect from Reliance Jio, the telecom vertical. Rima.
So Reliance Jio is likely to be the growth driver this time around. So on the top line, we're looking at a growth of a little more than 2%, revenue seen at 29,925. And this will be driven by a combination of ARPU increase of 1.5%. And some subscriber ads. Now, ARPU is going to be critical. It's been going up for the last couple of quarters. And remember, in July, the entire industry had taken a price hike. And the benefit of that is still flowing through. So in the current quarter, according to our poll, the ARPU should increase to 206 versus 203. And for Jio, they have a higher percentage of annual recharge customers compared to its peers. So that explains why, even after 3 quarters, they will get that benefit of the tariff hike. Subscriber ads seen at about 5 to 6 million on a sequential basis. Now, margins are seen on the flattish side, 52.8%, and the profit number, according to the CNBC-TV18 poll, should be 6,515. 2 key things to watch. One, the fixed wireless access, where the ARPUs are much higher, basically a 5G, that is seeing pretty robust addition. And secondly, the IPO timelines, because that is the monetization all investors are awaiting. So good numbers expected from Reliance Jio, and that standard disclaimer will come up for you on the screen.
The IPO timeline indeed, Rima, thanks a lot for that. But we'll look at retail as well. And, talking about the retail sector this time around, let's set this scale up. First things first, for Reliance Retail in the third quarter, it was a stellar quarter that had come by. It was a record-setting quarter because it also had festive seasons, etc. It was above all expectations. So, would that continue in the fourth quarter? Perhaps not. The street is expecting a bit of moderation in the retail growth year on year. And at the same time, quarter on quarter, there might actually be a decline. So if you look at the trend of the retail sales over the last 5 quarters, you would see that 4 out of 5, Reliance Retail has done sales of anywhere between 75 to 76,000 crores every quarter. It was just the last quarter that saw a spike, which was on account of festive season. So we might be somewhere in the middle of 76 to 90,000 crores in terms of quarterly sales for the fourth quarter as well. What will be more crucial to watch out for would be the EBITDA. Out there, the analysts expect between 11 to 12% jump in the retail business EBITDA year on year. And some say that upwards of 15% would actually be a positive surprise as well. So put all those numbers together, you're working with an EBITDA range for Reliance Retail this time around between 6,400 to 6,550 crores. Again, a number above 6,600 crores would be considered positive. What I'll be watching out for, apart from these numbers, are some strong internals. The most important one of them being what happens to Campa. Remember, Campa has been fairly aggressive when it comes to launches and expansions in terms of production and distribution as well as marketing. At the same time, there are new formats, the likes of Tira, we have Swadesh and Ustar, which is the value fashion doing extremely well. New commerce, which accounts for 18% of their sales, is something where we'll track the developments in as well. And to close the loop on Campa, remember at the end of the third quarter, they said that it's over 10% market share in select states. And at the same time, they are looking to clock over 1,000 crores in terms of sales for this financial year. What do they do in the next financial year? is something I'll be tracking fairly closely for Reliance Retail as well.
Interesting. And we keep an eye out on all of these. Reliance Retail and Jio are touted to be the growth drivers, right, for Reliance going forward. Be interesting to see how the numbers pan out. By the way, still at 23,980 now, so taking 10 points ahead towards that 24,000 mark is the Nifty, but still 270 points lower on the index. The Sensex is down 800 as well. Navin Fluorine has emerged as one of the outliers in what has been an otherwise weak broader market. That is up 3.5% in today's session, bucking the trend as we speak there. So 3% higher on Navin Fluorine. Nava is another one. That stock is up around 2%. But while Motilal Oswal is down around 6.5% ahead of its results, there is Nuvama Wealth that's up almost 3% on the flip side. But with that, we call time on this edition of Halftime Report. Mangalam and I will be back in another 30 minutes. But for now, Business Lunch takes all the action forward.